I have done many videos on SOFI stock, and I said many times that SOFI is one of the cheapest growth stocks in the entire stock market. And that was back when it was at $12, $13. Since then, the stock is up a lot. But I still believe it's the cheapest growth stock in the entire stock market by far in terms of the risk reward. You're not betting on a cyclical business, you're not betting on anything crazy. This is literally a bank, and it's a rapidly growing bank. And I still believe this stock has over 40% on the upside from now to 2026. So 40% in a year. I know it sounds too good to be true, but I'm going to show you the numbers and I'm going to talk about the company and the latest earnings report. And I really hope you enjoy it as always. And for SOFI, I mean, they've been absolutely killing it. Member growth over 34% year on year, 846,000 members in just one quarter. And this is despite Robinhood existing. And this is why I encourage people that watch my videos to not compare SOFI and Robinhood, because SOFI and Robinhood can both coexist. The TAM is huge. They're both taking market share from traditional banks like Bank of America and Wells Fargo that charge you maintenance fees for just having a bank account. SOFI is not going to charge you a $20 maintenance fee, or even TD Bank, which I have an account with them. If I want a paper statement, they charge me $3 a month if I want papers. You know, those banks, they don't do those things anymore. And they just have all kind of crazy fees. And SoFi is taking market share. Robinhood is taking market share. I own both of those stocks, and I think both of them can coexist. They also have a lot of products. But if you look at member growth quarter on quarter, it has been exponential from 8.1 million members in March of 2024 to now 11.7 million members. So this is absolutely insane. Revenue growth has been stellar, 44% so far, which is re-accelerating from 2024. You don't see that very often. Adjusted EBITDA is also re-accelerating in 2025. Earnings per share, or I should say net income, is also kind of re-accelerating. And now they have an 11% net income margin. Long term, that net income margin, in my opinion, could be close to 30%. I think this is highly achievable from the company. Now, if you're betting on SoFi, you're mainly betting on the company becoming more of a fee-based revenue business model. Now, only 44% of the company's revenues is through fee-based, and the rest is through traditional banking. And the biggest difference between the two is before the fee-based revenue, you used to go on the SoFi website and you want to apply for a personal loan, and you apply for the personal loan, SoFi would take the risk. They would hold the loan on their balance sheet. And if you don't pay the loan, SoFi is in big trouble. But SoFi is not doing that anymore, and they're transitioning to high margin fee-based revenue, which is why the net income margin has been exploding. It's 11%, given the fact that only 44% is fee-based. Once they transition to 100%, net income margin could be 35%, which is why I don't like to compare SoFi to valuing it like a Bank of America or a traditional bank. But with the fee-based revenue, you go on SoFi and you apply for a personal loan, a third party will buy the loan. So a third party will hold the loan on their balance sheet. SoFi will collect a fee because they hooked you as a buyer to the seller, and they also collect maintenance fees whenever you're making your payment on the SoFi platform. So it's a very high margin recurring revenue business model, and they don't have to take as much credit risk as they would have taken otherwise. Now, SoFi does a lot of personal loans, but they don't hold them on the balance sheet, which is important. And they also have home loans, which I believe will likely massively pick up in 2026, 2027, whenever they lower interest rates. And a lot of people ask me, what do you think about Zillow? What do you think about all those housing stocks if you want to bet on housing? Well, you could actually do that with SoFi, because people want to refinance at a lower rate, or they want to buy a new house. SoFi and Robinhood will be the platforms of the future for those people to refinance, or to even potentially buy a house, which in my opinion is pretty amazing. In terms of guidance, it was absolutely stellar. In 2024, they did 15 cents in earnings per share. This year, they started out with a guidance of 20 to 25 cents, I believe. Then they upped it to 27 to 28 cents. Now their guidance for 2025 is 31 cents per share. And this is something that the CEO is well known for, which is mainly setting low expectations for him to beat. And then he pretty much does it every single quarter. So with 31 cents, last year, earnings per share was 15. This is over 100% in earnings per share growth. So yes, SOFI is trading, let's say, at 53 PE, and it looks expensive because Bank of America is trading at 12 PE. But is Bank of America growing earnings per share 100%? So you should not just value SOFI like a traditional bank without taking into consideration their growth and the fact that they're going to have much higher net income margin once they transition to a fee-based revenue. But the report in general was absolutely stellar. Now, in terms of dilution, which was everyone was worried about, and everyone was asking me, what are you saying about the dilutions? They're going to dilute us as shareholders, and this is so bad in dilution. And the stock went down 6%, and people were crying after earnings on X. To me, it was really funny, guys. Like dilution, yes, they did issue like 72 million shares, 1.5 billion. They raised around 1.5, 1.6 billion dollars. Now, normally dilution is bad, okay? But it depends on what they do with it. So if they do some acquisition, which creates massive earnings per share growth after dilution per share metrics, this is amazing. REITs do this all the time. REITs dilute stock, but they're good investment because they create more value per share than they issue. So not all dilution is bad. Some dilution is actually great, especially if it's done at the right price. Now, since then, SOFI has issued a press release, and they pretty much talked about what they plan to do with the money. And they have three options. The first option is to pay down expensive debt. The second option is stronger position for potentially greater growth, so organic or inorganic, so maybe some kind of another acquisition. Some people said it's some kind of a crypto acquisition. That would make sense, but based on what I'm seeing on this report, they're more concerned with their debt than doing an acquisition, and SoFi doesn't like acquisitions too much. They like doing it organically, so I don't believe we will see an acquisition. Number three is increase SoFi's net cash position, which would generate interest and it would offset interest expense. Now, that would make a lot of sense because SoFi has a lot of debt at 5.7% rate, 5.5, 7.2, 6%. This is very high interest rate, and a lot of it is actually due in 2027. So if they can pay some of it off and reduce interest expense, they can create a lot of value for shareholders. And in my opinion, that would have been some pretty smart dilution from the company in terms of issuing stock. And I don't believe we're going to see an acquisition. I was thinking we would, but after I saw the press release, they talked about debt and interest expense 2 times, and they just put acquisition just to put it out there in case they see something. But SoFi likes doing it organically. They like doing it in-house. So they will likely expand in-house. I'm not saying an acquisition is possible, but I'm personally not seeing it. They will likely pay off some debt that's due in 2027. And maybe, keep it on the balance sheet and raise some cash. Now, in terms of the company's guidance, which my thesis is based on, they said, based on the latest report, they said we continue to expect or to exceed actually 25% compounded annual revenue growth from 23 to 26, and we really remain confident in delivering our earnings per share target of 55 cents to 80 cents by 2026. Now, I showed you how the CEO is very conservative with guidance, how he sets low expectations and then he beats. So we started at 22 cents this year. Now we're only 6 months in. We're already around 31 cents. We're likely going to end the year around 38, 40 cents. So in 2026, I would not be surprised if they reach 80 cents of earnings per share. So this is what I've been using as my target. And instead of using 50 PE, which might be high, I've been using 40 PE, which the stock hasn't traded there for too long. I think that's a little bit more conservative. So just to give you a very basic calculation, I'm taking the 80 cents in guidance, which I believe is highly achievable, and they could even exceed it, especially if they do some kind of an acquisition. And we're going to time it by 40 PE, this is $32 per share. The stock right now is still trading at $22 per share. This is over 45% on the upside over the next year with a company like SOFI. And I have to remind you that SOFI will likely keep growing earnings per share 20, 25, 30% for many years to come, as their fee-based revenue is only around 44%, and the goal is to take it to 100%. So it's a mix of revenue growth, which should be in the 20% range, and a net income margin expansion, which should drive massive earnings per share growth. So I really like the report. I like SOFI. I still believe SOFI is one of the best growth stocks to buy in this market. It's hard to buy it at all-time high, but you could have said the same thing at $14 and $17 and $18 and $19. So sometimes it's hard to ignore the chart and focus on the fundamentals, focus on the thesis of the company. And I actually bought SOFI early this year, and the stock went down 50%. And then I bought more at $10 and $9. So I don't care too much about the charts. I care more about the thesis and my long-term thesis. And to me, SOFI still looks like a great buy if you have the mental fortitude to ignore the price and focus on the fundamentals. And that's just my thesis, not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.